Welcome back to our intermediate financial accounting class. We're now coming back into part 2 of our 2-part series. Hopefully you're feeling pretty comfortable with the material we covered in part 1 and you're ready to move on and learn all sorts of new cool things. To get us started, let's take a look at our course structure. We talked about this many times during the first part of our course. Starting out with the accounting cycle, then talking about the balance sheet and the assets and the way we pay for those assets, talking about our income statement, the more advanced transactions that are part of calculating income from operations, and then talking about other gains and losses, taxes, and earnings per share. And finally, wrapping up our whole intermediate series with the discussion of retained earnings, using the statement of retained earnings, and then our statement of cash flows as the final capstone piece of the whole intermediate accounting series. In the first half of the series, we focused on these pieces of this course structure. We reviewed the accounting cycle in detail and became very comfortable with those concepts. We also looked at the current assets and other assets of the business, and then we just had time to get started on this last module, talking about the current liability piece of our liability and equity section of our balance sheet. And now we get to move on with that discussion. We're going to start by discussing long-term debt, and we're going to break it down, you can see, into 2 pieces. We'll talk about bonds and we'll talk about notes, and then we'll move on and talk about equity and wrap up our balance sheet. Now let's go ahead and get started with a discussion of why this topic is so very important. Well, first and foremost, long-term liabilities have important implications for all businesses. Why? Because they show our opportunities for growth. We have all these resources available, but on the flip side, we now have these limited future cash flows because we're going to have to use some of those cash flows to pay back our debt. And the more debt we have, the more limited our future cash flows are. So a lot of money now versus limited cash flow later. In addition, we've got funds now that aren't derived from our owners, which means that we're leveraging their initial investment and helping the business to grow. But on the flip side, we now have these debt covenants that restrict some of what we can do. And that's something that we'll talk about in a little more detail here in a couple of minutes. So long-term liabilities are important just for what they tell us about the business. They're also important because of the way they're used by managers, analysts, and other stakeholders to understand what's going on in the company. Look at how risky the company is. The more debt they have, the more those cash flows are limited, the more large payments they have coming due, the less opportunities they have and the more risk they're at defaulting. If something goes wrong, if the economy bucks just a little bit, we may not be able to make those payments and we go under. It's one of the things that actually helped to bring down Enron and its colossal fraud was the fact that they couldn't make a debt payment. We've already talked about the fact that future cash flows are limited. There's constraints there. We're limited not only in constraints with what we have to do with our money, paying back this debt, but also because of debt covenants, we might be limited in the way we can use the money that isn't tied to debt payments. So often we'll see a debt covenant that requires companies to maintain so much cash on hand, enough to make the next debt payment, for example, or the next, or 10% of the loan balance or something, as a way to limit the risk that a company will simply liquidate and spend all this money and never pay the bank back. So if we've tied up our money, then we can't use it for other things. So again, important information for analysts and managers as they look at these liabilities. And finally, does this high need for cash keep us from investing in the future? Most of the time we tend to focus on the fact that we may have a hard time keeping up our normal operations or return dividends to investors, but it also means we don't have the money if we have a good idea come up. If I can't invest in that project, I'm going to lose all the future returns of that project. So that's another important aspect of long-term debt, is what it restricts us from in our future growth. Now the last thing I want to talk about is that we tend to focus on the negatives of long-term debt. Oh, a lot of long-term debt means they're restricted, they've got all these problems and these troubles, but it also means the bank thought they were a good investment. They must have some good ideas. They must be making progress. The bank must think they're safe, at least to some extent. Not always. Sometimes banks make stupid decisions too, but the fact that one investor is willing to put so much money into a company and is confident that they'll be able to get that money back through repayments and interest payments, etc., means that we probably can have some confidence in the business. They may not be able to grow as much as we'd like later, but they're going to be able to use the money that they got from this loan to grow right now and then the bank or whoever the other lender is feels confident that they'll be able to generate enough cash to repay that debt. So it actually can be a sign of good things. Unfortunately, we have this negative connotation that, oh, a lot of debt is really risky, it's really bad. It does cause a lot of issues, and that leads us as investors to start to think, I just don't want to see it, or I don't want to see a lot of it. And because investors have this desire to not see a lot of debt, companies try to hide it. One of the most common of these methods, at least right now, is the use of leases. You see, if you structure your lease just right, you don't have to show it on your financial statements as an obligation. And there's a list of rules and ways that you have to structure it that we'll leave for a more advanced financial accounting class. But right now, just the concept that if I do this just right, even though I may have to make payments for 10 years and I'm legally locked into it, I don't have to show that as an obligation. A lot of companies think that's really cool, that they have that kind of flexibility. So a lot of long-term debt and the long-term assets associated with that debt just don't show up on the financial statements. One of the great examples of this is actually FedEx. We've all seen the FedEx trucks, the planes, etc. But most of those don't really belong to FedEx. They're leased, and FedEx has structured it in just such a way that you don't actually see either the obligation or the asset in their financial statements. They're in the footnotes, but they're not in the statements. And so it's almost like that information or those assets have just disappeared. So a lot of companies will try tricks like that. Don't get me wrong, these are legal. They're tricks only to the extent that if we're trying to deceive our investors, even within legal bounds, it's probably not the most ethical thing to be doing. But they are legal, and companies have gotten away with it for a long time. And there's some talk right now at FASB, maybe we should close some of these loopholes and make it harder for companies to hide these kinds of debts, because investors have a right to know that they have these obligations. Who knows how that's going to work out? Right now it's a big fight, and we'll see who wins. Well, let's talk about some long-term liability basics before we jump into some specific items that are included in long-term debt and some specific transactions. So long-term liabilities are usually due in more than 1 year or operating cycle. They're not associated with any voting rights, so they're not owners. They don't have any direct control by being able to vote for the board of directors or tell management what to do because we're an owner. They're usually structured around a specific stated rate of return, and along with that there's usually a very complex contract that the bank has set up in an attempt to make sure they get their money back. Or if they're bonds, again, there's a pretty decent sized contract there because the investment bank selling the bonds has tried to put as many restrictions and structures on there as possible to make sure the bondholders get their money back so the investment bank doesn't look bad. Finally, the last thing we see in long-term liabilities are the fact that they usually include what we call debt covenants or restrictions. And we've alluded to these a little bit in talking about why we care about long-term debt. But just to talk about it in a little bit more detail, these contracts are very large, and most of us are used to a debt contract like as a mortgage or as a credit card statement or a credit card contract, and those are fairly complex, fairly large documents, but they're nothing like the contracts that go along with a $500 million debt with no collateral. So we're talking about a lot of detail that goes into these contracts, and a lot of times they will create certain caveats or rules called debt covenants to keep the company from essentially taking the money from the debt holders and paying it out as a huge dividend to the equity holders and then declaring bankruptcy and walking away, which actually happened quite a bit before banks and other lenders got wise. So now they'll restrict things like you cannot pay a dividend that exceeds your retained earnings, and you must keep a current ratio of at least 2.5, or you must have at least X amount of cash on hand to pay your next interest payment at all times. As the loans get bigger, these covenants might include a seat on the board of directors. So I don't have voting rights because of the debt, I have voting rights because of the debt covenant, and it's not vote as an owner, it's simply vote as a member of the board. And I get to choose the person that sits on the board. It's usually one of my employees as a bank that I can control a little bit about what's going on in the business by having one vote on the board. Now, if a company violates these debt covenants, usually the bank has the right to recall the entire debt immediately. So if I violate one of these rules, I could end up having to pay hundreds of millions of dollars. There's actually a lot of academic research out there that shows that companies manipulate earnings to meet analyst forecasts. And they'll play around with their numbers typically in a legal way, if not an ethical way, to make sure that their numbers match what the analysts want to see. But there's also some interesting research out there that shows that sometimes companies will let earnings slide to make sure that they don't violate their debt covenants. Instead of manipulating net income numbers, they'll manipulate balance sheet numbers to make sure that they stay within these debt covenants and restrictions. So these become a big deal for different companies. Now, one of the other big issues with long-term debt is a significant difference between US GAAP and IFRS. This difference is based on the fact that long-term debt that's due this coming year should show up as a current liability in my balance sheet on December 31. So if I have a debt due on November 11th of the coming year, then here at the end of year one, as I'm wrapping up the year, that's now current liability because it's due 1 year from now in November of year two. Well, US GAAP looked at that and said, you know, if companies can meet certain requirements, we'll let them keep them under long-term debt. And here are the requirements. You have to be able to show that management has the intent to refinance the debt and that they have the ability to refinance the debt. And this can be, we've got the refinancing finished by the end of March when I'm going to disclose my full set of financial statements after the audit, etc. Or it could just be a letter from the bank telling the auditor, yeah, we're in the middle of negotiations, we think that we'll be able to reach a deal, it shouldn't be a problem. And that would satisfy US GAAP and allow companies to keep that current portion of long-term debt in long-term debt. Now, companies want to avoid it being in their current liabilities because it messes up their current ratio. And that current liability number being really big means that investors start to think you've got a liquidity issue, because how are you going to pay all of those current liabilities with just your normal current assets, and what are you going to do? And companies are going, well, I'm going to refinance, so I don't care. I'm just going to take out a new debt, and it's not going to be a big deal. But under US GAAP, you have to be able to show these two things to allow you to keep it in long-term debt and keep your investors from freaking out. IFRS took a look at that and said, no, you can't. We're not going to let you move it into long-term debt. We don't care what you've got. The only way we'd allow you to keep it in long-term debt is if it is long-term debt, meaning it's December 31st and I'm getting my financial statements ready and I've got this huge debt that's due on November 11th, and by the close of business on 12/31, the contract is renegotiated and I've refinanced. If I haven't got the refinance done by the close of business at the end of the fiscal year, tough. It has to show up as a current liability under IFRS. So they're a bit more strict than we are. A similar set of rules occur if we violated debt covenants. So if we violate our debt covenants and the creditor has the right or the lender has the right to recall that debt, under US GAAP, you should make it a current liability unless you can show that you're working with the lender to refinance or with another bank to refinance, or if you can show that the creditor has waived their right to recall the debt. Under IFRS, unless that's all done by the end of business on 12/31, tough, it's going into current liabilities. Even if you can get the refinance done on January 2nd, it still would end up as a current liability on your balance sheet for the previous year. Now, we've talked about a lot of important information about long-term debt. What we need now is some examples, and that's where we're heading in our next segment. I'll see you then.